We're joined by Nick Parsons to give you a little bit of perspective on where things stand right now. Nick, we've spoken in the recent past and we've spoken about how inflation is a problem, the possibility of a recession. The latest data points are coming in on the economy. Not really something that was not expected, but how are you reading that and how is the market looking at it?
Well, I think there are grounds for some cautious optimism in the price action across markets over the recent days. And most specifically, what we've seen is a decoupling between equity markets and bond markets. If you remember, for the first 4 months of this year, it was carnage. There was nowhere to hide. Bond prices were falling, equity prices were falling, everything was falling simultaneously. But during the month of May, we've actually now seen bonds rally. That means, of course, yields coming down. And we've got a divergence between the stock market and the bond market. And that, I think, gives us a bit of a scope for optimism, because previously we were thinking the Fed is going to tighten whatever happens because of inflation. But now the market is telling you, if you look at the interest rate markets, that, well, maybe the Fed might be thinking about a pause after the next couple of hikes. So there certainly seems to be a bit of a shift in the message from interest rate markets.
Okay, that's fair. But in terms of the data points that have just come out, there is a suggestion that consumer spending is in fact better than was previously thought. Businesses are spending well. There is also an expectation that in the April to June quarter, the economy might actually pick up a little bit compared with what happened in the first quarter of the year. Is this then building in terms of what could happen in the third quarter and the fourth quarter, in that you could see a deceleration then?
No, I think what's happening, you're absolutely right to point out the strength in the very latest GDP figures. But remember, that only goes up to March 31st. And what we've seen in subsequent data is a big slowdown in the housing market. Whether we look at the National Association of House Builders Index, the increase in mortgage rates that we've seen and the lack of affordability in the housing market is really causing a slowdown there. And I think there's every indication that that is going to weigh down on the second quarter GDP numbers, because the numbers that we're getting on housing are more up to date than these GDP figures that we've just seen released. And as I say, I think it's just possible here that the signals from the interest rate market are going to be offering some support to asset prices over the next couple of weeks in a way that they didn't for the first 4 months of the year.
Fantastic. Thank you so much, Nick, for joining in. And the perspective certainly is something that will give people some, good feeling at the end of the week.
My pleasure.
All right. Now